For internationally mobile entrepreneurs and investors, moving across borders comes with a massive, predictable headache: the worldwide tax net. Most tax systems operate on a rigid rule. If you physically live within their borders, the government claims the right to tax a percentage of everything you earn, everywhere on Earth. But there is a strategic workaround built directly into Turkey's tax residency law. It operates much like a classic non-domiciled framework. Look at this skyline of Istanbul's modern urban infrastructure. Turkey is appealing because it pairs its tax advantages with the massive scale and connectivity you see here, rather than forcing you onto a tiny, isolated island tax haven. This diagram illustrates how the underlying legal mechanism works. The law essentially splits your physical presence from your economic center of gravity, allowing your body to be in one country while your wealth stays anchored in another. Establishing residency in a highly developed strategic hub no longer guarantees your global wealth is automatically exposed to the local tax authority. We can understand this system by looking at this distinct boundary, separating the domestic Turkish economy from the outside world. Think of this as the domestic ring fence. Anything generated inside this boundary is fully taxable. If you earn a local salary, generate business profits from Turkish clients, or collect rent from real estate within the country, you will pay taxes on it. There is no ambiguity here. The law is designed to attract foreign capital, not to give you a free pass on local economic activity. But outside that boundary lies the offshore sanctuary. Wealth generated entirely outside of Turkey remains legally invisible to Turkish tax authorities. This view of traditional Dutch houses represents exactly the kind of stable offshore jurisdiction we are talking about.
If you have an IP holding structure in the Netherlands generating revenue, or you are earning foreign capital gains and dividends, that income is protected. There is exactly one condition for this protection to hold. Those assets must stay completely outside the domestic boundary. The Turkish tax code provides a highly effective shield for global entrepreneurs, as long as their wealth generation stays definitively outside that ring fence. This heavy gateway opening in our barrier represents the legal concept of remittance. Remittance is the exact moment foreign wealth crosses the border into the domestic zone, which immediately triggers a taxable event. A common and costly mistake is assuming that remittance only happens when you initiate a direct, deliberate wire transfer from a foreign bank into a local one. This flowchart traces hidden remittance triggers. First, offshore funds directly purchasing a domestic apartment or vehicle. Second, using an untaxed offshore account to pay a Turkish credit card. Third, channeling value to a family member inside Turkey. The tax liability follows. The danger compounds if you start commingling your funds. Mixing even a small amount of remitted cash into an account holding unremitted wealth can inadvertently taint the entire balance. The law does not care how the money moves. It cares whether your foreign wealth is funding your domestic consumption. If you fail to manage your cash flows precisely, the entire framework collapses. This timeline tracks a residency span from year 0 to 20, highlighting the framework's single overriding limitation. The moment you hit your 20th year of residency, the alert you see here signifies an automatic legal shift called deemed domicile. Watch as this solid boundary crumbles away. That is what happens to your tax shield. The protective ring fence dissolves entirely, and your worldwide income becomes fully taxable on an arising basis. This gives you a massive planning horizon, but it requires foresight. You need to structure your international wealth before you arrive in the country, not scramble to fix it in year 18. For tech founders and global investors, this is a highly efficient residency solution, provided the sourcing of your income is legally defensible and kept rigorously separate from your local expenses. A structural tax advantage means nothing without flawless execution. If you are serious about setting this up, engage experts like ÖZMEN-Consultancy to build your framework correctly from day one.